I'm not going to sugarcoat it. The data that I'm about to share with you is disturbing. This is Danny Gould with the Selling Silicon Valley Group. Welcome everyone to another shelter-in-place episode of the Silicon Valley Snapshot for the second week here of April in 2020. Let's just get right into it, guys. I'm not going to sugarcoat it. The data that I'm about to share with you is disturbing. By the way, a lot of what I'm sharing with you guys today is provided to me by my good friend, mentor, Robert Cruz. An amazing resource, has been an amazing resource for me since I started in my real estate career. And this man just continues to deliver every single week. So thank you so much, Robert. You are the man. You'll see down below here the Santa Clara County statistics over the last 4 years, okay? And what we're really looking at here is if you've been watching these videos for any period of time, you'll know that I said at the beginning of shelter in place, I would expect buyer demand to be pent up, and then post shelter in place, we'd get this surge of demand. But I was not so sure whether or not sellers were gonna be hesitant to dip their toe back into the water. And so I predicted at that point that there could very well be a rise in demand and a fall in supply until sellers in say August, September, October timeframe, once the hysteria dies down, or whenever that is, right? Like say December, if shelter in place, I don't know. But whenever the hysteria died down, that's when sellers would opt to all of a sudden all put their homes on the market at the same time. That is what I expected would happen. Intuitively made sense. The numbers are proving otherwise. If you look at the charts down below, March 23rd was the first week shelter in place was enacted, and now we're at April 13th. So this is basically a 4-week period here, leading up to today. And so you'll see that the active inventory in the single family sector is 864 units right now, which is down year over year, right? If you look at those charts. Now, if you look at, however, what it was in March, on March 23rd, we had 702 units. And so in that time frame, we had a fairly large increase. Now, if you look at that same time frame from the third week, from the 12th Monday of the year to the 15th Monday of the year, right? You'll see that we increased last year as well. In 2018, we also had an increase, and we also had an increase in 2017. However, when you measure the amount of condos and single families combined, and you measure the difference between the 12th Monday of the year through the 15th Monday of the year, we're seeing that active listings are up 23%. Whereas now every single year, inventory has gone up between the 12th and 15th Monday of the year. I expected, and I think we all expected, that inventory levels were going to fall, and that's the trend that we were seeing. However, shelter in place was enacted, and there was a knee-jerk reaction. A bunch of listings came off the market. However, since then, some of the rules and regulations surrounding shelter in place and showing capabilities for home sellers has loosened a bit, and so that has caused many sellers to put their home, or to consider putting their home back on the market in shorter time than I would have expected or anticipated. Now, however, or kind of like piggybacking off of that, see the active listings in 2019, 18, and 17 only went up 11 to 12% in this time frame. This year we're up 23%. Guys, that's concerning, because we expected inventory to go down during this time, and not only has it gone up, but it's gone up it's gone up faster. The acceleration has been faster over these last 3 weeks than we're typically accustomed to seeing. That doesn't make any sense to me, and I'm not really sure why, but I think a lot of sellers are reading the headlines right now, and they're realizing that every second that they waste is equity down the drain. Let's continue. So, those same charts, those same data graphs, you'll see that the pendings over the last 3 years, 17, 18, 19, from the 12th to the 15th Monday of the year, Pendings have gone up. Now, in 2018, they barely went up. But in 2019 and 2017, they went up pretty significantly, 13 to 15%. That's nothing to sneeze at. This year, we're down 26% in that 3-week period. So, in other words, supply has gone up, demand has gone down. Now, and not only has supply gone up, but it's gone up fairly significantly, and the pendings have come down fairly significantly. Now, why am I telling you guys all of this? Because obviously my job is to sell homes. Well, my job isn't just to sell homes. My job is to inform you and help my clients make the best, most informed decision possible. Could this be an anomaly? Absolutely, but we're measuring now over a 4-week period. This is not just a blip or a blip on the radar. This seems to be a trend that could continue into the near future, or possibly even further than the near future. What happens if this trend continues? Well, to put it very frankly, the market's going to go down. If this trend continues. Now, here's the funny part. These are all leading indicators of a market correction. The lagging indicators still seem to indicate that we are totally fine. The list to sales price ratio around the county is super high. In fact, I have that data here somewhere, and I'll flash it in the screen down below. List to sales price ratio is very high here in Santa Clara County and continues to be. However, what we're seeing here in real time is things playing out not the way that I anticipated 3 or 4 weeks ago. However, there is something else here to consider. Demand going down is a result of many things. Number one, the fear and uncertainty in the marketplace. Number two, the stock market's free fall, if you will. And number three, banks tightening up their lending practices to the point where many would-be Silicon Valley homebuyers are no longer eligible and or able to qualify for the loan that they thought that they were going to be able to qualify for. This was an article that was posted by Wolf Richter. Wolf Richter on April 8th. Purchase mortgage applications across the U.S. during the week ended April 3rd, ending in April 3rd, plunged by 33%. Okay, so purchase mortgage applications across the United States plunged 33% year over year. And a week ago, they plunged 24% year over year. Since the multi-year peak in January, purchase mortgage applications have plunged by 41%. Why is that relevant? Well, it means less people, less humans, less home buyers are applying for a loan at this time. Now, obviously, there's so many reasons why this is happening. Unemployment rates are up, right? There's less security in the ecosystem right now than ever before. And so when all these things start to line up, people start to get scared, and there are going to be naturally less home buyers. And if you've been watching my videos for any period of time, you'll know that I predicted that there was going to be less demand, right? That there were going to be less home buyers. However, what we couldn't have predicted, at least up to this point, is this rise in inventory, or this rise in relative inventory year over year over these last 3 or 4 weeks, when I would have expected inventory levels to go down. So inventory levels are up, demand is down. This trend continues. It spells chaos for the Silicon Valley marketplace. Now, what could save the Silicon Valley marketplace? Lots of things. Shelter in place getting removed by May 3rd would be a great start. The economy is in shambles right now because of the fact that there are many businesses, the vast majority of them are closed. And the ones that are open are essential, right? And so, what does that mean for us in the long term if shelter in place gets extended? The longer it gets extended, really, the more the more it impacts the economy, and the worse off we'll be. Now, by the way, I'm 100% on board with whatever our lawmakers decide to do. I am in full support of making educated, scientific-based decisions. So I'm by no means saying, oh, we need to do that. I'm saying if that happens, if they decide that it is a good idea, that it is in the best interest of the health of our citizens to do that, then it will certainly help our cause. However, if they don't, then it will continue to exacerbate the situation. Now, will there be a cap on how much inventory does come on the market? Absolutely. I think there are a lot of home sellers in the marketplace right now that post shelter in place, coronavirus is still going to be an issue. I do expect, if someone is in a high risk category, the likeliness or the likelihood of them putting their home on the market is fairly low, unless they are like forced to sell or absolutely need to sell because they've run out of retirement funds. And I've talked about this on videos before, but if they've run out of retirement funds, their retirement account just got slashed in half by the stock market's free fall. They're strapped for cash. They no longer have their part-time job that they were planning on having. I mean, these are all factors that would lead a potential home seller to put their home on the market. Whether or not they decide to do that because of their health and safety is really their prerogative. But I do anticipate that a lot of would-be home sellers that aren't in that position, meaning they're not forced to sell or don't need to sell, will take a second look or reevaluate their situation, and many of them will likely decide to hold off on selling their home to not expose themselves to the risk. And so that could very well mitigate the overall amount of inventory. But at the same time, there are still plenty of sellers, clearly, as we're seeing in real time, that are raising their hands and are saying that they are looking to put their home on the market. Relative, and let's talk about relativity here. Relative to other years at this time, it's not like we're seeing a flood of inventory. So I want to be careful with that, right? We're looking at relative changes in the market from the time shelter in place was enacted to now. The market's accelerating at a faster rate than we're accustomed to seeing in this 3-week time. However, when you look at other years, 375 condos and townhomes, even last year we had more than that. We had less than that in 2018 and 2017. However, 864 units, we basically last year had 300 more units on the market in the single family sector, and we did just fine last year. I mean, it wasn't a great year, but it was okay. And in 2017, I'm talking about home sellers, right? In 2017, we did 834 units, which is practically the same amount of homes that we have on the market right now. So the only year we had less was in 2018, and we all know how that year ended. So interesting times for sure. And I think I share all of this with you because you should be making the most informed decision possible. Here's my take on this. Will homes be harder to sell? Are homes already harder to sell? Absolutely. Will they continue to get harder and harder and harder to sell? Absolutely. Will there be opportunities out there for buyers? Absolutely. Will buyers still be in multiple offer situations? Probably. And I'll explain why. Because Silicon Valley still doesn't have a lot of our absorption rate is still very high. Our market is not flooded with inventory, meaning that there is still a very select amount of inventory out there that has the great home, the great address with the great street, with the golden doorknobs and the fancy toilets. I mean, those great houses, those those top 10% of listings that everyone seems to flock to. Those listings are still going to get eaten up really fast. We have not transitioned into a market where those listings are no longer attractive. In fact, I would say even argue that new construction sales are even though they're going to be hindered, new construction is going to be fine. I really think that the sellers who are going to be really, really, really tight or have really big issues in selling their homes are the ones that are in distress and their homes are not in good shape. I think those and anything in the middle of the road, right? Just like the vanilla house on the vanilla street with, the vanilla zip code. Those listings, those are the ones that are going to hurt the most. So there will be no middle ground anymore, right? You're either going to get kind of shuffled up to the top or you're going or the home's value is going to drop tremendously, and I don't think there's going to be much in between. Another thing worth mentioning before we end this video, and I know this video is going super long and it's just me ranting, and bear with me though. Jumbo loans have been, the jumbo product is a shadow of what it once was at this point. Many lenders, including Chase, they've completely updated their guidelines, updated the amount of money that you need to put down, the percentages that you need to put down in order to qualify, and they've really tightened up their lending practices and their qualifications, period. So what does this mean for home sellers, or home buyers rather, is that, pretty much every area in Silicon Valley has homes that are well up and above and beyond the $1 million mark. And anything in that top quartile of any market is going to suffer tremendously during this time. And what happens in the high end, right? Whatever happens in the top quartiles eventually trickles down to the rest of us, right? And I'll explain why. Because right now, home buyers' purchase power are going to be impacted negatively by all of this. Purchase power will be impacted negatively. And the first to feel it is going to be the top end. And then it's going to be, and then the second quartile is going to get, is going to adjust. And then the third quartile, and then the fourth quartile will adjust, but nominally, right? So if you have a home that's worth, say, $600,000, right, in the valley, the impact will be felt less by you, but anyone in that top quartile of any zip code, right? So it's different by zip code, right? Like if you're in the top quartile and say like, East San Jose, you're looking at $1 million plus. But if you're looking at Cupertino, you're probably looking more towards like $2.5 million plus, right? So those are the differences, right? Or 2.75, right? So the top quartile of every market is going to experience is going to experience any sort of correction or adjustment first, and that is almost always been the case, but it is especially going to be the case now with lenders tightening up their jumbo products. Purchase powers will be affected, and anyone that was able to qualify for those top quartiles, they still may be able to qualify for it, but they'll be able to buy less house or the same house but for less money. So we'll see what happens. Something's got to give, guys. But this is very fascinating. It's very, very fascinating. So stay tuned, everyone. Stay safe out there. Stay healthy. My team is here to help any of you and all of you throughout this pandemic. This is we are going to stick together through this, and together we're going to come out of this stronger than we've ever been before. This is Danny Gould, everyone, with the Selling Silicon Valley Group, and I will catch all of you in the next video.